go back to the lecture, right? You can simply go back to the lecture and try to understand what we have in the lecture, right? So there's there are videos that I posted to the YouTube so that you can check it, you can watch, rewatch, and so on and so forth. So we are going straight to another standard today, which is IAS 7, which is one of the um, components of accounts that you must prepare. And you must know that in financial accounting or in financial reporting or strategic business reporting, we have or what we call there are components of accounts that we must prepare. There are certain accounts that are compulsory for us to prepare at every point in time. So one of those accounts that are very important is what we call IAS 7, which talks about statement of cash flows. Now, why is it important for us to learn this statement of cash flows? So I think we are starting from here. Yeah, so it is it. So why is it important for us to learn statement of cash flows? Now, because most times we want to make decisions, right? We want to make serious decisions, critical decisions, and we just need only cash to make that kind of decision. When you check your financial statement are usually prepared on accrual basis. What does it mean? It means that they record expenses even when you've not paid money. As far as you've incurred the expenses, you recognize that you are already owing somebody. So you treat it as though you have paid money. So when they say something is accrual, it means that when you go to your financial statement, as far as you are owing someone, right? You are owing someone, you go to the financial statement and recognize that expense. That is accrual. So you recognize expense once it has been incurred. How do you say something has been incurred? Well, maybe I give out a tax to somebody. I have a piece of land. I want that piece of land to be cleared, right? I called those outside guys, they should come and clear it. Once they've started declaring, and I'm sure that they're going to clear it, they finish clearing it already. I assume that an expense has been incurred, right? So I go to my financial statement, I post that, okay, expense on clearing, I post it there. Even if I'm not giving them, even if I've not paid them, probably I put them that, okay, wait till I'm expecting some money, the money is going to drop by so numbers of days, right? Is when you come by so numbers of days, I'll be able to pay you. However, I go to my financial statement. As far as that expense has been incurred, those people have rendered the service and I'm owing them. I go to the financial statement, I recognize that kind of expense. Okay, so that is accrual basis. You also have some sales that you made. Probably you made one normally on a normal basis, you make sales of let's say 1 million, okay, or more than that per month. Then you just got a new client, and the client is ready to pay, is ready to buy something worth like billions, right? So he paid, he said, okay, supply me so goods, right? Like for 1 billion. You've not done it before. And all of a sudden, you supply the guy that 1 billion. You discover that when he got to his place, he did not pay you immediately. He tell you that, okay, don't worry, I won't pay you now. I'll pay you at the end of 3 months, for instance. You agree and you say, okay, since it's a big sales, why? No problem. Let us leave it at that. You are accepted. But as far as you have earned, as far as the goods have left your premises, you have delivered it to the person, right? They say you have earned that income. They say you have earned the income. So as far as that goods have left your shop, you have delivered it to the person collected it in good condition, right? In very good condition. They say that you have earned that kind of income. So in your financial statement, you are not only recording the normal sales that you normally make, which is like maybe roughly 1 million, you're also recording that extra money that you also made. So your account is going to be showing that you made a sales of 1 billion, 1 million for that period, right? So if you use that kind of financial statement, right, that does not really show that is not really, I don't know, it's not actual. You are adding some things that even you have not collected money for. You are putting some things that even you have not paid for. So that account, you cannot actually make informed decision from it. For instance, you want to buy a piece of land, and then you are looking at your account. Your account is showing you that you made a profit of 20 billion, whereas somebody, the billion on it, they've not even paid the money. So you cannot make an informed decisions with that. That's why there's a component of financial statement that is called the statement of cash flows. What does it do? It only records any transaction that is on cash. Anything that is not on cash will not be here. So if you want to make decision about money, want to invest money, can we go about investing the money and all that? You need to go and use this component of financial statement, which is called the statement of cash flows. This one will tell you in real terms how much we actually have in the company, how much came in, how much went out, okay, per period, okay. So this tracks how much spending you've made, how much came in, and so on and so forth. Are we together? If you're together, just give me a thumbs up. Let me be sure you're following. Okay, just anyone is with me. Mr. Fufwe Johnson, are you with us? Beautiful. Okay, so I believe everybody is actually with us and then is making sense. So if there's any point that you don't understand, you can easily call my attention and I'll be glad to answer you. Okay, so let's now move further to the main topic. I've already given you like an overview and introductory stuff into the course so that we understand why we really need to do statement of cash flows. Because at some point when I was preparing, when I'm preparing for exams, okay, I just start asking myself, why do they bother with this kind of topic? I mean, they're just stressing us and all those stuff. So you don't also feel that they are stressing you when you're looking at statement of cash flows. You should know the reason why we are actually looking at the statement of cash flows. You could have just said that statement of profit and loss and other comprehensive income, is it not enough for us? Statement of financial position, is it not enough for us? Why are they giving us statement of cash flow again? Why are they giving us value added service? So you must know the reason why they are putting each of those statements, okay? So this one now helps people to make informed decision, okay, based on the actual thing that happened in the business, the actual cash that came in, the actual cash that came out. So it's like monitoring cash that came in, monitoring cash that went out in the business. So objective now of IAS 7, which is statement of cash flow, the objective is that to provide information about the historical changes in cash and cash equivalent of an entity. So the main purpose, okay, the main purpose is to provide information about the historical changes in cash and cash equivalent. Now, for those people that I gave so we are starting a training today, which is going to be on Zoho Books, right? Before that, I already sent them a video on chart of accounts. So in that chart of account, I break down different elements. So there are elements of accounts as well. There are components of account. When you're looking at statement of cash flows, statement of profit and loss and other comprehensive income, statement of financial position, you're talking about components of accounts. However, when you're looking at assets, liability, income, expenses, equity, you're talking about the elements of account. So element of account is actually different from component of account. Okay, so in that chart of account that I gave them, which is on YouTube, you can always check it. I break down what the cash and cash equivalent of any organization should be, what it should be made up of. So you can also go and check it in that regard. So the purpose of this statement of cash flow is to give us information about historical changes in cash and cash equivalent of an entity. Now, that is the objective, I mean to say. Now, the purpose is that they say statement of cash flows is a part of a complete set of financial statements of an entity as recommended by IAS 1. It provides information about, number one, the cash flows of the entity during the reporting period and the changes in cash and cash equivalent during the period. What are the benefits? A statement of cash flows provide information that helps users to evaluate changes in the net asset of an entity and in its financial structure, including its liquidity and solvency. When you're talking about liquidity, you're talking about solvency, you're talking about the ability of somebody to stay liquid. Like, you have money, enough money to pay up expenses. As the expenses are arising, you have money to pay them. It's not like you are having financial crisis, right? So a lot of people, nobody wants to have financial crisis. They want to, at every point in time when expenses are coming up, they're able to meet up all their obligations, right? Fathers want to meet up their obligations for their home. Also, companies want to make up their obligation to their suppliers, their customers, and every other person. So they want to stay liquid at every point in time. So if you're not financially literate, if you're not disciplined in your spending, if you don't track your expenses, how much have I spent? How much am I earning? So at times you need to do that calculation. How much came in this month? How much is my salary? How much did I spend this month? So you now be able to say, okay, if I'm able to make this amount of money and I'm spending this amount of money, I mean, either I'm overspending or I am actually in track. I'm spending rightly. So we all need to do this analysis, income versus expenses analysis, okay, cash inflows, cash outflows. So in order for us not to go out of money, so that we can stay liquid, right? Liquidity. And when you also talk about solvency, I think it's talking about your ability to stay. Let me quickly do something on solvency. If somebody send something to the class, please, sir, I am at work. Okay, no issue. No issue. Now, yeah, so solvency. Solvency. So whenever they are saying a company is solvent, it means that the asset of that company exceeds its liability. So most times when you're trying to look at your solvency ratio and so on and so forth, we are trying to check your asset, right, against your total liability. It's different from when you're saying you are trying to stay liquid. When you're saying liquid, is like you have money to always meet up your obligations. There's money in your hand, right? If any expenses should come now, you're not going to be in crisis. You are not going to be in financial crisis. So that is for liquidity. But for solvency, you are comparing the asset you have, you are comparing it to the liabilities you have. Can these assets, are they enough to actually settle your liability? So you always do a solvency test to know whether, okay, to know the numbers of liability you have acquired, right? The numbers of liability you acquired as against the asset that you have. So in case of a scarcity, maybe there is an emergency, the people you are owing, they want to come, the banks you took money from and all that, they want to come. Are you able to really settle your obligations, okay, from the assets that you have acquired? Okay, so it's always good for a company to always carry out this liquidity ratio to know how liquid they are, and also the solvency ratio to know if whenever there is an emergency, they can easily settle off all their debt, right? So that is for that. So that is one of the benefits of cash flow statement. It enables us to evaluate the changes in the net asset of an entity and in its financial structure. Okay. So the next one, it helps users of account to compare the performance of different entities, because unlike profits, comparison of cash flows are not affected by the different accounting policies used by different entities. So the another thing that it does is that it enables us to compare performance of different entities, right? So then the next one, it is useful in assessing the ability of the entity to generate cash and cash equivalent. So it also helps us to assess whether the company can generate cash and cash equivalent. So what is cash and cash equivalent? Cash and cash equivalent, those are those assets, right, that can easily be converted to cash. An example, your cash balance in your bank is already in cash form. Your cash at hand, right? Cash account is also in cash. Then we can also talk about your debtors that are owing you. Whenever you have any need to actually settle any obligation, you can quickly run to them and tell them, please pay me my money. Okay. So we're talking about things that can easily be converted to cash and cash equivalent. Okay, so they say that it's useful in assessing the ability of the entity to generate cash and cash equivalent. I want to beg us, let's make sure we don't miss out on any of these IAS 7 lectures, because it's a very important lecture. It's not only important for us to pass the exam, it's also important for us to know it for the sake of work and practice, right? They also say that it provides information that help users to assess the ability of the entity to affect the amount and the timing of cash flows in order to adapt to changing circumstances and unexpected opportunity. Then historical cash flows are often a fairly reliable indicator of the amount, timing, and certainty of future cash flows. The next one, to assess the performance of the management. The next one, to know the liquidity position of the entity. The next one, for investment and divestment decisions. The last one is to meet daily obligations. So all these are the benefits of understanding cash flow statement. So you can always go through this at your own leisure time. Okay, it's very important. You can also go back to the lecture and also get it. Now let's now look at the sources and the uses of cash. What are the sources of cash? What are the uses of cash, right? You say cash flows are inflows and outflows of cash and cash equivalent. IAS 7 requires sources and uses of cash flows to be analyzed during the following headings. So when we are talking about the sources and the uses of cash, we are looking at the various ways in which cash can come in and cash can actually go out. So I think there are three main headings that we're going to consider when we are talking about how cash can come in and how cash can go out. Okay, the first one is operating activities. There are certain activities of the business that we compare, we regard as the operating activity, right? So for you to continue to be in business, you must always carry out the operational activity. So this operational activity, this represents the principal revenue generating producing activity of the entity and other activities that are not investing and financing activity. So this operating activity is the main activity that the company carries out, right? So they ask you, what kind of business are you into? I'm into export and import, right? So that operational aspect of it, your day-to-day activity, exporting, importing, those are the operational aspects. So it represents the principal revenue generating, producing activity of the entity and other activities that are not investing and financing activities. So all those activities put together that enables you to generate revenue as an organization, but that does not involve investing your money. It does not also involve financing a project, right? So if you want to finance a project, you can either go to the bank to borrow money. We're not talking about loans that you're collecting. We're not talking about investment that you're making. We're not talking about when we are under this section, when we talk about operating activity, we are only talking about those daily, the principal revenue generating activity that you carry out, which is like you sell, you buy, day-to-day activity. Okay. Now, items to consider, because in cash flow statement, these activities are the things that they're asking you to do. You must compute them. What are the operational activity? How much do you make for operating activity? What are the investment activity? How much do you make from investing activity there? What is your financing activity? Okay, so you must know them. The first one is that we're looking at is the operating activity, and we've already mentioned that is the revenue generating activity of the organization. So the items expected to see under these operating activities are these four items. Under operational activities, there are four items that is expected to be seen. Number one, we talk about cash received from customers. So when you are transacting with customers, customers are likely to pay you money, right? For the services you render to them, for the goods you sold to them. So the first activity that we're looking under operational activity is what we call the cash that you received from customers. That's number one. Number two, we are looking at cash flow statement. We're only looking at everything that has to do with cash. The next one, we're talking about cash paid to suppliers. So when you pay cash to suppliers, you're paying cash to suppliers because they supplied you goods that you are selling to customers, right? So that is cash paid to suppliers. The next one we'll talk about cash paid to employees in form of wages and salaries. Then the last one, cash paid to government in form of taxes, right? So all these four activities are what can be classified as operating activity. Cash that you receive from your customer, cash you pay to your supplier, cash you pay to your employee in form of wages and salaries, cash you pay to government in form of taxes. Then we now move to the next activity. The next activity is actually investing activity. Now, if you have any question, you need more clarity, you need clarification, feel free to call my attention, and when I will answer you, just raise your hand in the chat. That will be able, and I'll be signified that somebody needs my attention. So the next thing we're looking at is the investing activity. So when you talk about investing activity, obviously from the way the name sounds, you know that when you are investing something, you are putting your money and then you are expecting a return on your investment, right? So investing activity, what is investing activity? Now, what are the things that we can classify as investing activity? So this represents the acquisition and the disposals of long-term assets and other investments not included in cash equivalent. So they're telling you that investing activity involves the acquisition, you're buying. When you're acquiring something, you're buying, and the disposal of long-term assets. So when you're talking about all fixed assets, all assets that are fixed, okay, long-term assets. So the disposal, the acquisition, if you ever buy them, they're looking at, okay, how many purchases did you make in a year? How many new purchases did you make in a year? That is number one. They're also going to look at how many disposals, how many of your assets did you sell off during the year? So they're looking at the asset that you purchased during the year, the asset that you sold during the year. So that investing activity. Also, they're also looking at other investment that you entered into. Probably you invested in MTN shares, you invested in Dangote cement, you invested in Bua cement, and so on and so forth. So how many investments did you purchase? How many investments did you sell off? So on that investing activity, that is all they're looking at. They're looking at the acquisition and the disposals of long-term assets, acquisition and disposal of investment. Okay, so now they say items expected to see under this investing activity. So what are the items you're expected to see under this investing activity? I've mentioned them already. They are like number one, acquisition of assets, then disposals of assets. That's number one. Those are the things that you will see. The next thing, we also look at acquisition of investment, disposals of investment. Now, there are certain things that is linked to us buying asset and disposing asset, buying investment and disposing investment. Now, when you invest your money, right, it's always natural for them to pay you dividend. They pay you dividend for investing your money, right? Anything that you received, whether you receive a dividend received and all that, anything that you receive is all is a linkage. Is you receive them because you invested your money. They wouldn't have given you, for instance, let's say in your account, you woke up this morning, you saw that you have a credit allowance from Dangote Refinery and you are not a staff of Dangote Refinery. Obviously, it means that you have invested your money in Dangote Refinery. So they are now paying you, either they are paying you dividends for investing your money and all that, or maybe they are paying you interest for also borrowing Dangote Refinery your money. Okay, so it's either you loan Dangote Refinery your money or you invested in that. So anything received, anything that you see that is received is a linkage to because you invested. So for instance, if you receive dividend, okay, if you receive dividend, you receive it because you invested your money, right? If you now also receive interest, you receive interest because you borrow somebody your money. So anything received is a linkage to investing activity. Anything you receive is a linkage to investing activity. So that is fine. At least if I ask us now to mention the 6 components, what we are going to see under investing activity, we should know that we are looking at acquisition of asset, disposals of asset, acquisition of investment, disposals of investment. Now, because you invested, you are expected to receive certain things. So you are going to receive dividends, is one of the linkage. You are also going to receive interest because you loan somebody your money. So you're going to receive interest. So anything you receive is a component of this investing activity. So they said, note, all non-current assets are investing activity, and of it is the starting point to calculate cash flow statement. Now we are done with the operational activities, right? We've done with the operational activities, which involves the cash we pay to customers. Sorry, the cash we receive from customers, cash we pay to suppliers, cash we pay to employees in form of wages and salaries, cash we pay to government in form of taxes. Now, the next thing we want to do is we have also done our investing activity. For under our investing activity, we've seen that for us to invest our money, it means that we must have so if we invest our money, we also expect something in returns. When you invest your money, you're expecting dividends, you're expecting interest on the loan that you borrowed out. So you must also know this investing activity. Then the next thing we are looking at is financing activity. How do you finance your project? You have a project to carry on, you need money to execute that project. So how do you raise funds? So when you're talking about financing activity, you're talking about the activity that you carried out that enables you to be able to raise funds. So they say this is the activities that result in changes in the size and composition of the contributed equity and borrowing of an entity. So the activity that results in the changes in the size and the composition of the contributed equity and borrowing of an entity. So items to expect under this financing activity, there are just 6 items. Just as we have 6 items over here, which we talk about acquisition of asset, disposal of asset, acquisition of investment, disposal of investment, then things that you received for all those things, dividend received, then finance income, that is interest you received. So those are 6. Then we also come over to this place. Now we are talking about how we are able to raise capital, okay, to finance our project. So you can issue share capital. So this should be like share capital and all that, or stated capital. This should go to, let's say, to maybe share capital. Let me go and by raising shares in the stock exchange market. So one way in which you can finance your project, you need 20 billion for a project, right? One way you can do that is that you can sell part of your company. So if you want to raise money, right, when you are the only one pushing the business, you are the only one carrying the business, it may look so heavy for you based on what you want to achieve. Probably you want to compete with Dangote refinery. You want to go into cement, you want to go into oil and gas, you want to go into a lot of things that it does, right? So you as one individual, if you don't have the kind of resources I have, you cannot venture into what it does. So the best way to do is that instead of you to carry all the weight by yourself, why not sell part of that vision to other people? Like, okay, buy into this vision. Let's co-own this business, right? You are selling away, probably like you're selling away like 49% of your interest, right? In that industry. You're selling away 49%, you're having 51, so that you are the decision maker in that business. So you just sell away 49% to other people, they invest in it and all that. So when you raise shares in the stock exchange market, you are trying to get people to buy part of your share, part of your company, right? So they invest their money into the business, right? So that is the first way in which you actually raise money to finance a project. Number two, when we talk about share premium, what is the meaning of share premium, right? So share premium is that normally in your company, in your organization, you know that the to buy part of your company, the worth of that company is probably one share goes for like 50 kobo, right? You know that that is the worth of that company. Now, because you now have probably look at they say I should speed came to Nigeria. Then there's this very strong man that normally does crazy things, right? So I should speed now met with him, and immediately I should speak took interest in that guy. All of a sudden, the following of that guy started to increase. The guy now on Facebook, the guy is like having 1 million followers. So before it was like not up to that 1 million followers, but immediately I should speed met with him. They sat in a downfall bus together. You know, he was showing I should speed all the things that he could do. All of a sudden, the following of that guy now started like increasing. It's like I should showcase the guy to the world. So different people from different places of the world now, they now know that guy. So before, if that guy normally charges like 500,000 to come to your show to display all those skills that he has, but now if you call him, he can tell you he doesn't want 500,000 any longer. That no, his price has doubled. He can tell you to give him 1 million, or he can tell you that okay, pay me 5 billion or 100 million. So you can see that there's an original worth of a business, right? Then there's an additional worth that the business is now having due to probably the goodwill of the company, due to certain things that have happened, okay, to that company. So that gives us what we call share premium. There's an original cost, an original price attached to that shares before. But instead of it to sell it for 50 kobo, you sold it above the original, the nominal value, right? That's what they call the nominal value of a share. So you sold it above the nominal value of that share, and then you now that extra that you sold it for is what we call the goodwill of that company, right? You sold it for something extra. So now that is what share premium is about. So let's look at it. They say shares can be sold on premium instead of the nominal value because of the goodwill of the company. They can decide to sell at a market value. So let's say that normally this company is located in one village, right? Nobody knows the company, right? Then all of a sudden, Speed came up and just came and give that kind of company a facial recognition. Just went there and just advertise one of their products, just like show it to the world that no, this product is fantastic. People try this product. This company is located in so rural area. Please try their product. You discover that because he has showcased that product to the world, that product that initially was selling for probably 50 naira, okay, now you cannot compete with the world market where that kind of product before is being sold for probably 500,000. So you can now just take that product now to the market and also sell it 500,000 because there's a market value. There's an amount that they actually sell those kind of class of products in the market. But you, because you are in a rural environment, you don't have facial recognition. You might be selling it at a very low price but now when you now have goodwill, you can stop selling at that old price and just sell to people that are interested, sell it at the market value. So let me also give us another example. Let's assume you have you sell power banks, right? And one of those influencers, it just came up on TV and say, when I was traveling on a journey, like 12 days on the road, all right, and I needed power to power my system, my gadgets. Lo and behold, this power bank came in very handy to me. I was able to use it and it lasted me for the whole of the journey. So immediately it gives that your product a facial value. Everybody starts looking for that product, right? So if you have it in the market before, it's just trading in the market. everybody start coming to rush that product. Now you know that okay, you have just 12 item, you have 500 people asking for the item. You can push up the price from the normal price to whoever the highest bidder who can buy it. So if the product was selling for 100,000 before, now because a lot of people are coming for that product, you can shoot it up to 1 million. So the highest bidder among the 500 people will buy it. So there's what we call share premium. I just using that to let you understand what can give rise to share premium. Okay, there's usually the nominal price of a product. Then there's what we call the market value. How much is it worth? How much do they sell that class of product in the market? Okay, you can sell your product if you have goodwill, okay, to sell it that way. So one of the ways in which we can actually raise funds is through our share capital, right? Selling part of our business. The next one is through share premium. Then the next one is what we call borrowing. So you need to finance a project, you are going to borrow money, right? So you are borrowing that money purposely because you want to finance a project. So let's look at it now. For individual, corporate organizations, or bank. So you're borrowing money from individual, corporate organizations, or from the bank, e.g., 8% loan note. So you want to go for an 8% loan note. So you issue out a debt instrument, which is called a loan note, to somebody, and you tell the person that, okay, I'm going to use this your money, right? I'm going to use the money for like 1 year. So in exchange, I'll be paying you 8% of that money as interest every month. So you collected a certain amount of money to use that money in your business. And you now say, okay, the amount I'm going to give is 8%. So when you say 8% loan note, it means that money you are going for, you want to be paying interest of 8%, okay, depending on the time, duration. Probably you're saying you are taking that loan for like 12 years. So those 12 years, each year you're paying 8% of that loan as interest to the person. So it means that the person gave you 10 million as loan, you collected that 10 million, you are using it for your company, you're using it to trade, right? In exchange of it, every year you are giving an interest, 8% of 10 million as the interest that you're paying to that person. Okay. So then apart from this loan notes, we can also have preference shares. We can also have preference shares. Then we can also have the ventures and so on and so forth. When we are talking about preference shares, right? Preference shares, they are always paid preference dividends. So these people, they are people that also invest in your company, right? But they are not, they're actually not they are not the ordinary shareholders. There's something they call ordinary shareholders. Then there's something they call people that are just borrowing money. So preference share is one of those people. They are just financing your business, right? They are financing your business. They are not the ordinary shareholders. That means that if anything occurs, you have to settle them first. You pay them first before you now start talking about the owners of the business. So in a situation whereby you are transacting and then you now, God forbid, you decided to import certain containers, right? Those containers now, because you are doing well, we have Ratel movement. We have Ratel movement. We have what's this other guy that is competing with Darkman? So that guy. So let's say because you see that those guys are trending online, you now invested the money in their business. Then now you that invested money, you are there's a difference between just throwing their money as a loan, and also there's a difference between buying part of the company. So if you buy part of the company, you're not only buying the the goodwill of that company, you're also buying whatever losses they're going to make. So if you buy part of their company as a shareholder of that company, so there's what they call ordinary shareholders, and there's what we call preference shares. So these preference share people, they just say, okay, I want to import certain things. Okay, just loan me money. I'll be paying you interest. So it's just like another kind of loan, but you're also borrowing money. Okay, so but these people, when you want to settle people, you settle them first. Then there's anything remaining, you now settle the of the business. So are we together, everybody? There's a company, I feel like all is trying to stop. Can you hear me, everybody? Let me see a thumbs up if you can still hear me. Hello. Okay, fine. So that's good. So now let's now move on. Now we are done with yeah, so we've looked at that borrowing, right? How we are to raise funds. We've looked at borrowing. So you can borrow money from the venture. So just give me 2 minutes. Hello? Yes, that's correct. This is the lead tutor at Tel Johnson, Mr. Leakey. Yes. Yeah. You're welcome. To my number. Or you can also put it on the platform. Anyone. If you are in our class, in our group, yes, you can put it there. Yeah. You're welcome. All right. So sorry for that. I'm so sorry. I'm so sorry. So now we've looked at that. We are looking at how to raise money, right? So we've looked at borrowing. You can either raise money by issuing loan notes, preference shares, debentures, etc. So now, what are now the linkages to all these things? Now, because we borrowed money, what is the implication on our finance? What happens to us when we borrow money? We need to pay these people interest, right? So it means that when we borrow money, we must pay dividends to our shareholders. We must also pay what we call interest, right, to the people that borrow us money. So all these things, there are linkages to all these financing activity. I already told us that the 3 ways we can raise finances is by issuing our share capital, by also having share premium. If you have a share premium, fine. Then also by borrowing. Okay. Now, when people invest in your company, they become shareholders. You must pay them dividends. So anything you pay. So yeah, now under our investing activity, I said anything you receive, right? But under financing activity, anything you pay. So you are paying dividend to shareholders. You are paying interest to the people that you borrowed money from. Okay. So you are paying all those things. Then the last one is finance lease obligation. Finance lease obligation. The rent you pay on finance lease obligation should go under financing activity. So now when we talk about finance lease, right? Finance lease, in a finance lease, you are like borrowing an asset. You're trying to use an asset, right? And when you're using that asset, we're using the asset, and then you now in exchange you pay consideration to the owner of the asset. So you can decide to lease a building, for instance, lease a building for like 20 years, right? So that finance lease obligation you have on that property that you lease, is also something you must pay. Anything you pay, you are paying it out, right? You are paying it out as probably I took somebody's building, right, for my business. So I didn't rent it. I'm not renting it, right? I lease it for more than some period of years, right? I lease that building for like 20 years. So that obligation you have on that leasing, the finance lease is an obligation to you, which you must meet actually. So that leasing is that leasing is also what you must pay. So that is that for that. All those things are linkages to what I mentioned, right? So now, the first one, what did you pay? You pay dividends to people that are your shareholders. You pay interest to people that borrowed you money, right? You also paid you have an obligation that you are paying on something that you leased, right? So like that, like that. So all these things are what you pay. So when we already understand all these three components of cash flow statement, then we can move on to look at definitions of other terms, right? Well, let's look at definitions of other terms. Then we now go to how to prepare cash flow statement in any exam. Okay, so definition of term. Now, the first thing is cash. What is cash? Cash is cash in hand or demand deposit. So that is what cash is. Cash can be, you know, cash at hand or demand deposit. Then when we talk about cash equivalent, we are talking about these are short-term, highly liquid investment that are readily convertible to known amounts of cash and which are subject to an insignificant risk of changes in value. Cash and cash equivalent should have a short maturity period to say 3 months or less from the date of acquisition, since they are held for short-term cash commitment rather than investment purpose. Cash and cash equivalent includes short-term deposit, loan notes, bank deposit account, and so on and so forth. So when we're talking about cash equivalent, we're talking about those things that are highly liquid, that can easily be converted to money. And they say that for you to talk about a cash equivalent, it must be something that has a short maturity period. Okay, you can easily convert it into money. Okay, so that is what they call a cash. So the maturity period should not be more than 3 months, right? Or less from the date of acquiring it. So that is that. Now let's now come out to hear how to now prepare the cash flow statement. To prepare statement of cash flows in any exam, here are what is required. Number one, so these are the things that you must look out for, because we are looking at exam now. Exam has started. In case you get to the exam hall and you sit down, these are the things that you should try to remember. Okay, when he was teaching us, this is what he said, this is what he said, and this is what he said, so that you can be able to know what to do in the exam. So the first thing you're going to do is in the exam, they are going to give you the profit and loss statements, the profit and loss account, right? When you are doing cash flow statements, you are necessarily not preparing account from the scratch. They will give you a ready prepared account. Your statement of profit and loss and other comprehensive income will be given to you. The statement of financial position also will be given to you. So which of them do you need, right? So now you need the current year profit and loss account is all you need. You don't need for last year. You just need for the current year. That means that in an exam scenario, if they are giving you a cash flow statement to carry out and they gave you the profit and loss account for like 2 years, you don't need for the late period. You need for the current period. It's only that profit and loss that relates to the current period that you need. Okay, so just check the profit and loss account that I'm giving you, which is the latest, like now that is current. That is the only thing that you need. So they say that the current year profit and loss account, if they give you 2 years profit and loss, like 2023 and 2024, you don't need for 2023, you only need for the current year, which is what that of 2024. That's what you need. Then the next one, statement of financial position. So when they give you statement of financial position, they will likely give you for 2 years. You need for the 2 years, right? It's only profit and loss account that if they give you for 2 years, only take the current one. But if they give you statement of financial position, okay, which is your balance sheet, you need for the prior period, and you also need for the current period, because in balance sheet we always compare what happened last time to what happened this time. Okay, so you, for balance sheet, for statement of financial position, you actually need for the concurrent year, the year before and now, and the year now. So you need balance sheet for 2 years, the current year and that of the comparative year. E.g., if you are to prepare cash flow statement for 2024, you need 2023 and 2024 statement of financial position. Are we together? Are we together? Are we following? Is it making sense?
Yes, sir.
Okay, so that's fine. So it's making sense. So let's move on. So those are the things that you need, right? So also, you now go to additional information. There is additional information in the question. Information involving, so when you go to the additional information, these are what you are looking for. You are looking for information that involve non-cash items. So you are looking out for information that involve what? Non-cash items. And I've been singing this thing over and over again. There are certain items that they call non-cash items. Items that does not involve movement of money. Items that do not involve movement of money. So just go to the additional information. You will see all those items that do not involve the movement of cash. So they say item that does not involve the movement of cash. E.g., they talk about depreciation. When they say in the question, you saw that they charge depreciation, okay, or they give you information about the depreciation that they've charged, okay. Depreciation is always charged on tangible fixed assets, such as PPE, okay. If they give you any information about depreciation that they charge in the question, note that this depreciation is not a cash item. Therefore, you cannot charge it as an expense. I've sang about it before. Depreciation. Depreciation is not a cash item. It does not involve the movement of cash. But when we are treating it in our financial statement, we go and treat it as if it's an expense. We are reducing the income that we have by charging depreciation against that income. So it's going to be looking like an expense. And in reality, depreciation does not involve movement of cash. Cash is not living. The cash you have in your statement of profit and loss is still the same amount, even though you are charging an expense that is invisible. We cannot see that expense. That expense did not occur, right, in that period, right? So depreciation is not a cash item. So this depreciation, we are going to always add back depreciation. Just like when we did IAS 12, we added back depreciation. When we are doing cash flow statement also, we are also going to add back depreciation. The next thing is amortization. Amortization is also an example, is almost the same thing. They call it, it's also depreciation, okay? But this time around, we are depreciating intangible fixed asset that you cannot see with your physical eyes, right? So we are depreciating them. They call it amortization. You amortize intangible intangible assets. So you amortize intangible asset. So such intangible asset, we can talk about goodwill, we can talk about patents and all that. So this is also a non-cash item. Then the next thing you also want to take note of is under additional information, you're looking out for non-cash item. And that you also want to look out for is goodwill, either impaired or written off. So when you're checking additional information that they give you, check out for information that deals with goodwill, right? Goodwill, they say goodwill has been impaired or goodwill has been written off. When something is impaired, you know what it means now? Impairment. We've done impairment, IAS 36. In your account, probably you are carrying that goodwill as a price that is higher than the recoverable amount. Okay, so goodwill that is impaired or written off. So how do you know that goodwill is impaired or written off? How do you know that? Say if you look at the statement of financial position, right, and the non-current assets section, right, in your statement of financial position, in okay, and then in 2023 you have goodwill of 80, and in 2024 it has come down to 60. So let me show us graphically so that you understand what I'm trying to say. It's not cast on stone, right? All these things I'm saying, they are not cast on stone. So let's say like you have years. Here we have let's say we have years. So this is how usually things are being done. Sorry, give me 2 minutes. Somebody is one of our tutors, they chatted. So let me quickly check what she's saying. Your okay. Hold on. Yeah, good morning, Mr. Johnson. Okay. Yeah, so now how do you know that goodwill has been impaired? So let's say that you are checking your financial statement, you saw that in 2025 there's a certain amount that goodwill was, and then you compare it to what it was in 2024. So here we now say here we have goodwill, right? We have goodwill. So in 2025, let's say you have goodwill to be 60, right? You have 60 million. Then in 2024, probably you have goodwill to be like 80. Now, if you check it now, in 2024, it was 80, and now it is now 60. Therefore, something has happened to that goodwill. That goodwill has been reduced. There's a reduction in goodwill. Is it as a result of impairment? You know, impairment can make something to be written down. If you check the carrying amount of that goodwill, and you compare it to the recoverable amount, probably you discover that the carrying amount is actually higher than the recoverable amount. So you must reduce that goodwill to its recoverable amount. At every point in time, they want asset to not be carried at more than the recoverable amount. So let's assume you've gotten the recoverable amount of this goodwill, right? And the recoverable amount of the goodwill, you discover that the recoverable amount is actually 60, and you are carrying it for 80. You know, it has been impaired. So you have to write down that goodwill. So let's assume in 2024, we're carrying that goodwill for 80 million, right? Then when we get to 2025, because you have to carry out goodwill, this in every impairment test every year, right? So when you come to 2025, you have to check the goodwill you have. Is it still the same, or or it has impaired? So how do you check for impairment? You are comparing the carrying amount of that asset, you are comparing it to the recoverable amount. So if the carrying amount is higher than the recoverable amount, you need to write down that recoverable amount. So you need to write down that asset to the recoverable amount. Okay. So you now come to in 2024, the asset was 80. Okay. In 2025, it's now 60. Therefore, this thing has reduced. Something has happened. Is it as a result of impairment, or has it been written off? So that is that. So you need to determine that. So when they say something is written off, right? When they say something is impaired, it will reduce. But when they say something has been written off, let me give us an example. If something is written off, let's come here. Let's say we have goodwill again. Let's come here. We say we have goodwill. When something is written off, let me show what I is going to be. So we have goodwill again. Goodwill, right? We come over here. We are having dash. Nothing is there, right? Then in 2024, we saw that goodwill was actually 80. But when we come to 2025, we discover that it's no longer there. So it has been written off. So this is how goodwill can be written off. In a prior period, it was 80. In the current period, there's nothing. So it has been written off. But if it's impaired, in the prior period is what, 80. In the current period is now 60. So it has reduced. So that is impaired. It has been impaired. Okay. So if we are together and you understand what I just said, simply give me a thumbs up. If you are together and you understand what I'm saying, give me a thumbs up. I'm waiting. Okay, so I think somebody on this, yeah, so fine. So that's it. So that is when something is impaired and when something has been written out. So when you go to additional information, I said things that you are going to look out for in additional information, go and look out for the non-cash items such as depreciation, amortization, and all that. Then the next thing you want to look out for is you want to look out for the goodwill. What happened to goodwill? Did they give us information about what happened to goodwill? Has goodwill been impaired? Has it been written off? So the best way to check it, if they don't give you any additional information, you can also go to your statement of financial position, go and check your current asset section, right? Under your current asset section, you will see the goodwill. You check for the prior period, check for the current period, just like the way we, let's assume this is our current asset, right? Let's assume this is our non-current asset in our balance sheet. Just go and check the prior period, the current period. What is goodwill there? Then what is goodwill now? So you should know whether it has been impaired or whether it has been written off. You should know that. So after you've done, so the things I said you look out for: number one, check out for the current year profit and loss account. Check out for statement of financial position. You need 2 years. Then also go to additional information. Go and check out for information that relates to non-cash items, right? Then also check out for goodwill information, whether they will say it in the additional information. If they don't talk about it in the additional information, go to your balance sheet. Go and check the non-current asset section. Check out for goodwill. Has goodwill been impaired? Has goodwill been written off? So go and check out for it. Then after we've looked at those 3 things I've mentioned, we now go further to look at all this other information on disposals of assets and investment. So we need to check out for information on disposals of assets and investment. The next one, we need to now also check dividend paid can also be seen in additional information. So if you go to additional information also, you can also see dividend paid. And why do we need to pay dividends? So who can tell me, why do we pay dividends? When do we pay dividends? Who can quickly unmute and tell me why we need to pay dividend and when we pay dividend? Then if you know that, also tell me dividend received. Okay, why do we pay dividend? Why do we receive dividend? When and why do we do that? Who can tell me? Who can unmute quickly? Let me be sure you have been following and you understand what I've been saying. So when do we pay dividend and why do we pay dividend? When do we receive dividend and why do we receive dividend? Quickly, somebody should quickly unmute and quickly give me that answer quickly, without wasting time. Somebody that is following, that's been following the class. Do I call names?
Hello, sir.
Yeah, I can hear you. Go on.
Dividend is paid usually at the end of the year to the company's shareholders.
Okay.
Yes.
All right.
Sir, a company pay dividend to share profit within its owners.
Okay. So now you got yeah, you got that. But the question is that you pay dividends. Under which of the activities will it fall? Is it going to fall under operating activity? Is it going to fall under investing activity? Is it going to fall under financing activity? So who can tell me?
Investing activities.
You are paying dividends, right? Madam, as you're answering, you pay dividends to shareholders. So are you paying dividend to shareholders because you invested your money into something?
No, it's financing activity.
So that is financing activities. I just wanted you to know we have 3 activities now. So when you're answering questions, we're answering it on that line. We have operating activities, we have investing activity, we have financing activities. So any question I'm asking you to classify it under each of those items. Which of them will it fall into? So we already agree that when we are paying dividends, we are paying dividends to people that either invested in our company, they are our shareholders, they bought shares in our company. So that is when we are trying to raise money we issued out shares to these people. They bought shares, they bought part of our company. So we carried out a financing activity because we wanted to raise money. So now, because they've invested their money, they are now our shareholders, we need to pay them dividend. So anything paid is going under financing. Anything interest paid under financing, interest paid, dividend paid, everything goes to under financing. But when we talk about anything received, dividend received, dividend paid, sorry, dividend received, interest received, all those funds go to our investing activities. Because when you invest money in Dangote Refinery, you are going to receive dividend from them. When you borrow them money, they are going to pay you interest, so you receive interest from them. So I want you to know that very well, so that all these things that we are doing will not look confusing to you as we carry on. So that is that. You've looked at all those things, dividend paid, you also know where it is. Then you can check out in additional information, you get information about the dividend that was paid. Then dividend received also, and also finance income. So this finance income, interest received. So when you check your financial statement and you see finance income, don't get carried away. Finance income means interest income, interest received, dividend received, interest received. If they are not part of profit and loss item, just go to additional information. You will find out information about dividend received and dividend paid. You're also going to get information about finance income, which is interest received, and so on and so forth. So let's quickly do a class exercise, because we don't want to assume that you know it. So I think we've done this already, to differentiate between. So this is what you're going to do now. Quickly differentiate between the following: dividend paid, dividend received, interest paid, interest received. So let's quickly do this now. In the next 2 minutes, let's quickly do this. So differentiate between dividend paid and dividend received. So what kind of activity is it, and when do we receive and when do we pay? Then also talk about interest paid and interest received. What kind of activities do they fall under, and then when do we receive that, and when do we pay that? So quickly, let's do that. So I don't want it to look so voluminous, what we have learned and all that. So let's just use, our class is almost over. We have like 5 minutes, okay, to the end of the class. So let's just use that time to quickly brainstorm and put down something. You can put it down in the group chat where we are, the differences between dividend paid and dividend received, interest paid and interest received. Then when we come next time, we're going to be looking at the format of how to do our cash flow statement. So before we go on, let me tell you that, okay, we will do that one I told us. But before we go on, let me quickly share light on this format of cash flow statement. So their format of cash flow statement, when you are doing cash flow statement, there are 2 formats that can be used. At times, the examiner will tell you, using cash flow statements, do direct method. You can also say, using cash flow statements, we want you to do indirect method to do cash flow statement. It means that as a student, you must know the 2 methods, right? You must know the 2 methods. Now, let me now tell you the differences between the 2 methods. The 2 methods, they are almost the same, except for, so let's go up. So you see that here, your operating activities, right? Your investing activities, your financing activities. Now, the only difference between direct method and indirect method is this operating activity. Operating activity is the only difference, is what makes direct method and indirect method to be different. Both of them, the same way is how you are going to treat your investing activity, the same way is how you are going to treat your financing activity. The only thing that differentiates the 2 methods is your operating activity. So the format of statement of cash flows, IAS 7 does not specify a required format for a statement of cash flow. Sorry, IAS 7 does not specify a required format for the statement of cash flows. However, it provides illustrative format. Okay, it provides illustrative format. It also states that cash flows should be presented under 3 headings, right? Cash flows should be presented under 3 headings, right? Cash flows from operating activity, cash flows from investing activity, cash flows from financing activity. So when you are trying to get your cash flow statement, you are trying to get 3 activities. The first activity is operating activity. The second activity is investing activity. The third activity is what? The financing activity. And we've looked at them in details, right? So I'm sure you understand them. You still need to go back to them in order for you to still grab more knowledge about them. Then there are 2 methods of now doing all the 2 methods. They must have operating activity, they must have investing activity, they must have financing activity. But the way you do your operating activity is what differentiates direct method from indirect method. The way you do your operating activity. So it means that from next class, which is going to be tomorrow, we are going to look at the different method of carrying out our cash flow statement. Okay, so that's what we're going to do from next class. We're going to start from the methods, right? Direct method. When you're looking at direct method, this is what we're going to do. The one we're doing, so just know that the only difference between the direct method and the indirect method, I said, it's only the way you treat your operating activity. Other than that, the other activities are the same for both methods. So let's unmute our mic and let's ask questions. We are done with this class for now. Let's unmute our mics and let's ask questions. Yes, any question, please? Any question, please? Mr. Ridwan, do you have a question? Your mic is unmuted. Mr. Ridwan. Okay, we can't hear you actually. If you are speaking to us, we can't hear you. So any other person have any question? We can't hear you, Mr. Ridwan. So let me mute your mic. Any other person have any other question? So if you want to speak, you can unmute again and then you can ask question. Okay, so he has unmuted again, but we can't still hear you. I don't know if it's from my end. Can any other person hear him?
No, we can't hear.
Okay, so does any other person have any question? Because the class will be ending shortly.
My question will be maybe in the next class when we do workings, because the question I wanted to ask is the opening cash. Where is it coming from? You know, because we need to bring in an opening cash, right? So where is it coming from? Is it from our bank statement or where?
Okay, so
yeah,
so thank you. Yeah, thank you for that question. Now, you discover that you have done your accounts, right? Which is your statement of profit and loss and other comprehensive income. You have already done your account. In your account, you have so let me also differentiate between profit and loss and statement of financial position. Under your profit and loss, you are doing income and expenses. So in your profit and loss account, the only thing you're going to do there is your income that came in versus your expenses, how you spend money. Money came in, money goes out. That is what you see in your statement of profit and loss account and other comprehensive income. So other comprehensive income is a wider scope that we're not going to touch in this class. We're only going to limit ourselves to statement of profit and loss. Other comprehensive income is not for your level. I think is more than your level for now, but just deal with only profit and loss account. So in the other profit and loss account, we're only looking at money that came in, sales that we made, and also how the money went out. Okay, maybe your cost of sales, your administrative expenses, your selling and distribution expenses. So we're only comparing income versus expenses in that profit and loss account. But when you go to balance sheet, it's balance sheet now, your statement of financial position. That is, so balance sheet is called statement of financial position. So under your statement of financial position, they're not talking about all your assets, whether it is fixed asset, it is current assets, and so on and so forth. So now, remember I told you that. So under your assets, so under your financial position, your balance sheet, you are having your assets, you're having your liabilities, right? You're having capital. So now you're having information about your assets, you have information about your liabilities, you have information about your capital. So under the asset, you're going to have fixed assets. Those assets that are tangible, motor vehicle, plant and machinery, furnitures and fittings, what other thing, office equipment, and so on and so forth, right? You're going to have all those fixed stuff. Then when you now come to under your current asset are those assets that you're expected to use them up in the next 1 year. So under your current asset, you're going to see things like cash and cash equivalent. So for those of you that have not watched my video on chart of accounts, I will advise us to go and watch that video on chart of account. It's going to break down our assets to us, right? You see those assets, you see, just go and look at it, you see what the element of account is. So that element of account, I broke down all the elements of account. When we talk about asset, I talk about liability, I talk about capital, I talk about income, I talk about expenses. So when you check it, you will see the breakdown of those things. So here in your balance sheet, you're going to be having assets, you're going to be having liability, you're going to have capital. Okay, those are the three things you're going to see. So under your asset, I've told you, you're going to have fixed assets, you're also going to have what we call current assets. So that information you're asking me about cash will likely be in your current asset. Your current asset now is those assets that can easily be converted to cash in the next 1 year. So there you are going to see your receivables, that is your debtors, people that buy things from you on credit. You're going to see it there. You're going to see your receivable inside there. You're going to see your inventory inside there. You're going to see your cash and cash equivalent. You're going to see it inside there. You're also going to see your prepayment. Your prepayment will be there. You're going to see a lot of things there, right? So those are the things you're going to see in your current assets. So that balance, that cash balance you're asking of, is likely going to be inside your statement of financial position under your current asset section. And you go to cash and cash equivalent, it's going to be there. So those are the things that you need. I told us we need those things when we are trying to solve this thing. So look at what I said we need again. You need what I said you need. Number one, I said, where's that place? Let me see my more. Yeah, so yeah, this is it. I said we need the current year profit and loss. Profit and loss shows us income and expenses. What income did you make? What expenses went out? Your statement of financial position shows you your asset, your liabilities, and also shows you your capital. So under your asset, you're going to see fixed assets, land and building. You're going to see property, plant, and equipment. You're going to see all those fixed assets. You're going to see motor vehicle. You're going to see furniture and fixing. Then under your current assets, you're going to see inventory, your stock. You're going to see debtors, your receivables. You're going to see cash and cash equivalent. So that can be found under. So they're going to give you. You're going to sit in your statement of financial position. So it's part of the things they're going to give you, information they're going to give you. Madam, do you understand that? Do you understand?
I understand.
Yeah, thank you very much. So, in the absence of any other question,
Sorry, please, I have a question. Good morning.
okay, good morning, madam.
This is my first class for FE. I joined last week. So I don't know if there are other classes I need to probably listen to that
Okay.
like prerequisites to this topic that we're treating.
Okay, so this topic that we're treating is a new topic actually. So the topics that we've covered so far, I think we've done IAS 36. If I'm not mistaken, we've done IAS 36. We've done IAS 36, that is impairment of assets. We've done IAS 12, income statement. Sorry, IAS 12. That is what I call IAS 12 again. Who can remind me what that topic is? Income what? Income taxes. Yeah. So it's income taxes. Then this is a new topic that we are starting today. We are starting IAS 7 today, which talks about statement of cash flows. So you've not missed anything. We can always have access to all the recordings. Like the IAS 12 that we worked on, income taxes, is on YouTube. You can ask for the link, ask somebody to share it to you in the group. You can always go to their place and go and see the stuff. So this one also that we're looking, I'm going to also upload it so that we can also have it on YouTube for people that are interested. Now, any lecture I'm taking that I want to cut across different classes like foundation, skills, professional, I will always upload it on YouTube so that once I'm sharing it to you, I'm also sharing to them. Okay, because some of these topics they are needed at different levels. So that's why I say that anything I teach you in this level, if you understand it very well, when you get to your skills level or when you get to your professional level, you will not struggle because you already have a solid background of what is being taught. Okay, so on that note, if there's any other question, you can ask now or we can call it a day. Any other question? So in the absence of any other question, Mr. Whitman was trying to unmute his mic. Mr. Whitman, can you try again? Mr. Whitman, or you can drop a chat on the chat box quickly before we go so that I can quickly attend to it. Okay, so the absence of any other question,